Hello students, today we will be discussing on issue like fundamentals of deductions from gross total income of an assessee. Actually, income tax is a tax which is obliged to be paid by the taxpayers to the central exchequer as a compulsory payment out of their hard-earned income, provided their income crosses the basic exemption limit or so under the Act. The compulsory tax payment is not quid pro quo, means that nothing is receivable in consideration of tax payment from the government, at least directly. Indirectly, the taxpayers get benefit from government in the form of various public expenditure program like setup of government public buildings, hospitals, constructions of roadways, railways, airways, waterways, etc. And for this purpose, obviously government requires a huge amount of revenue which is greatly received from tax revenue. And as this is collected from the taxpayers are in a burden to pay. So, under the Income Tax Act, to give some reliefs to the taxpayers from their compulsory tax payment so that they can reduce their tax burden, several deductions under Section 80C to 80U under Chapter 6A is allowed under the Act as deduction from gross total income while computing taxable income of an assessee. This is the basic of deduction from gross total income. Now we will be coming on to the deduction in respect of life insurance premium contribution to Provident Fund under Section 80C. It is a very popular section because a large section of the people, individual, Hindu undivided family, etc., they take this benefit of Section 80C by contributing or depositing money in different aspects considered under Section 80C. But here it is to be kept in mind that the total amount of deduction under Section 80C is restricted to rupees 1,50,000. That is, at best, a taxpayers can enjoy benefit under Section 80C provided he or she paid rupees 1,50,000 or deposits 1,57,000 under different areas of deductions available under Section 80C. The first is LIC premium, life insurance premium paid by taxpayers for their own life of spouse, children, dependent or independent, male or female, minor or major. In all cases, the LIC premium paid by taxpayer is allowed as deduction. But if the policy is taken before 1st April, the amount of deduction shall be restricted to 20% of sum assured, and in case of others it will be 20% for policy taken after 1st April 2012. If a policy, such policy is issued before 1st April, maximum 20% of the sum assured is allowable as deduction. However, for policy taken in the financial year 2012-13, maximum 10% of the sum assured as LIC premium paid is allowable as deduction. But if the policy is issued on or after 1st April 2013, maximum 15% of the sum assured is allowed as deduction under Section 80C in respect of any ailment or disease mentioned in 80 DDB, but in all other cases maximum allowable rate is 10%. This is regarding LIC premium deduction under 80C. There are many deductions are available as already told, that is payment in respect of non-commutable deferred annuity, sum paid to any provident fund of the employee including public provident fund, recognized provident fund, statutory provident fund, etc., contribution to 10 or 15-year accounts of post office savings bank, subscription to any notified securities or issued deposit under NSS, subscription to any notified saving certificates, unit linked saving certificates, that is NSERT issue, and interest accrued thereon, any amount or part payment or purchase or construction of residential house property paid to a housing board or cooperative society, or repayment of housing loan taken from bank or any cooperative bank or any national housing bank, etc., is also allowed a deduction within the ceiling of 1,50,000. Contribution to notified plan of LIC, Jivan Dhara, units of UTI, notified mutual fund are also included. Subscription to mutual fund notified under section 23. Subscription for deposit to public sector engaged in provisions of housing, and subscription to equity shareholders of any approved eligible issue of any capital made by a public company or public institution. Tuition fee at the time of admission or otherwise for children to any school, college, university or other educational institution for the purpose of full-time education of 2 children of the individual. So these are the scope where deduction under section 80C is available under chapter 6A. Now deduction in respect of pension fund, section 80CCC, where a taxpayer deposited or paid amount in any annuity plan of LIC or any other insurer for receiving pension, the amount deposited for the annuity plan or rupees 1 lakh, whichever is lower, is allowable as deduction, and this shall be included within the total ceiling of section 80C of rupees 1,50,000. Next, deduction in respect of contribution to national pension scheme. It's very much important because since after the employment of any employee under the government sector from 1st April 2004, it has been made mandatory to join national pension scheme. So this national pension scheme is also available for deduction under section 80CC D. The deduction can be availed under section 80D in respect of 2 ways, where contribution made by employee or by self or salaried employed to NPS, and contribution made by employer to NPS. For employees, the maximum deduction permissible for employees is 10% of their salary income and DA, and in the case of self-employed, the maximum deduction is 20% of their gross total income in the previous year. The amount of deduction under section 80D is limited to 1 lakh, and the cumulative selling deduction taking 80C, 80CC and 80CCD cannot exceed, however, 1,50,000. Section 80CCD also provides an additional deduction of rupees 50,000 for contribution made by NPS over and above the deduction available under section 80CCD. That is, total deduction in this case will be including all 2 lakh only for opting the old tax regime. Deduction under section 80C allows for contribution by employer to NPS of an employee. For contribution by central or state government employee, it is 40% to be considered. For contribution by employer under the old tax regime, maximum deduction is 10% of salary, and in case of employees providing their own contribution under the new tax regime, it is 14% of basic salary and DA. Next is deduction in respect of investment made under equity saving scheme 80CCG. This is effective from 1st April 2013. Deduction under section 80CCG is available to an assessee being a resident individual if his gross total income does not exceed rupees 12 lakh. Section 80CCG of the Income Tax Act states that the tax deduction under the scheme will be available to only first-time equity market investors having a valid demat account. Section 80CCG of the Income Tax Act permits a deduction of rupees 25,000 per year for investment in equity shares, a scheme notified by government subject to a maximum limit of 50% of the amount invested. Now, payment of medical insurance premium, this is also very important area because medical cost has become very much painful to the taxpayers. So, under section 80D, the government of India has provided benefits to the taxpayers for providing mediclaim premium or medical insurance premium. and under section 80D this is available to any Indian citizen or foreign citizen, resident or non-resident, or Hindu undivided family for medical insurance premium paid by them out of their chargeable income, and it is available for deduction if it is paid only in any other mode, that is NEFT, cross check, bank draft, etc. other than cash. General deduction in case of assessee, own life, own medical insurance, spouse, dependent children amounting to rupees 25,000, and if the spouse or any of them becomes senior citizen, that is above 60, then the deduction will be double, that is 50,000. And additionally, for the benefit of assessee's parents, deduction is available to 25,000 whether the parents are dependent or not, but if the parents are or any one of them is above 60 years of age, that is senior citizen, in that case it will be double, that is 50,000. So in maximum under section 80D, if the employee himself, any or his spouse is a senior citizen and parents, any of them or both are senior citizen, then maximum 50,000 plus 50,000, 1 lakh deduction available. The same deduction available in respect of medical insurance claim by a member of a Hindu undivided family. Now section 80D, this is medical expenses for treatment of handicapped dependent under section 80DT. This is medical treatment expenses of a handicapped dependent with disability under section 80DD. This is deduction which is available to an individual or a Hindu undivided family for providing medical treatment of any handicapped dependent, and in that case under section 80DD straight 75,000 will be allowed as deduction if the disability is 40% or above, and in case of disability 80% or above, the deduction will be 1,25,000 disregarding actual amount of expenditure incurred. Here dependent means spouse, children, parents, brothers, sisters of the individual or Hindu undivided family member, whatever may be. Then we are coming to section DDB, deduction in respect of medical treatment. This is deduction of medical treatment in respect of the taxpayers for which resident and ordinary resident for specified disease or ailment. Here specified disease may include cancer, dementia, motor neuron diseases, Parkinson diseases, AIDS of the taxpayer himself or herself. That is, this deduction of medical treatment is related to taxpayers himself or any other person dependent on the taxpayer, that is husband or wife, children, parent, brother, etc. The amount of deduction is recommended rupees 1 lakh if the medical treatment is taken in respect of senior citizen and super senior citizen person, or the amount actually paid whichever is less, this is ceiling, and in case of others it is actual amount paid or with 40,000 whichever is less is allowed as deduction. Then section 80E, where a person takes loan from a financial institution for the purpose of higher education of his or for any relative, children, spouse, etc. in India or abroad, deduction under section 80C is available, and the whole amount of interest is allowed as deduction, and it is available for a maximum period of 8 years or till the interest is paid, whichever is earlier. Now section 80EE and 80EEA, these are all regarding buying or acquiring residential house property. First we are taking section 80EE, where a taxpayer who is taking a loan for acquiring his first house, that is first time, in case of first time buyer of residential house, this 80E is applicable for getting deduction. The condition is that the loan is to be sanctioned in the financial year 2016-17 and the amount or the value of house purchased should not be more than rupees 50 lakh. The amount of loan sanctioned does not exceed rupees 35 lakh, Section 80EE deduction is in addition to the deduction normally available under Section 24B while computing income from house property already provided under Section 84. This is in addition to that. And interest paid on housing loan under Section 80EE limited to rupees 50,000 per annum. Now 80EEA. This is also regarding purchase or acquiring a residential house by a person by taking home loan. The loan is sanctioned, should be sanctioned between 1st April 2019 to 31st March 2022. Stamp duty value of the house purchase should not exceed 45 lakh. Section 80EEA deduction is in addition to the deduction available under Section 24B of the Income Tax Act under the head house property. The amount of deduction for interest on housing loan is available and is limited to 1,50,000. So whereas under Section 80EE the deduction amount is max 50,000, in case of Section 80EA the amount is 1,50,000. Section 80EEB, this is in regard to deduction for purchase of electric vehicle. That is, whenever a person, taxpayers, takes loan from any bank or financial institution for purchasing electronic vehicle, he or she is entitled to a deduction under Section 80EEB subject to satisfying certain condition. The deduction under Section 80EEB is available for the interest on loan taken from any financial institution between 1st April 2019 to 31st March 2023. The amount of deduction is limited to the interest paid on the loan subject to a maximum of rupees 1,50,000. If the vehicle is used for business purposes, then the registration of the vehicle must be made in the name of the business carried on by the assessee, and it is available to the taxpayers like individual, Hindu and family, association of person, partnership firm, companies, or for any other entities. Section 80G, deduction for donation to charitable fund. This is also very popular deduction because persons very often donates or pays to various organizations, charitable institution or many funds or others, and this deduction is available in case of any individual, company, firm or any other person, whether resident or non-resident, for donation made to specific funds or institution. However, to get this deduction, the donation above rupees 2,000 shall not be made in cash, and the amount of deduction is limited to 10% of the gross total of the assessee, subject to certain deductions and exclusions. In some cases of deposits or donations, the deduction is available at the rate of 100%, like donation to Prime Minister's National Relief Fund, National Children's Fund, Swachh Bharat Course, Clean Ganga Project, any approved institution or educational institution of national eminence, etc. In certain cases, the deduction is 50% under Section 80G for donation made to Jawaharlal Nehru Memorial Fund, Indira Gandhi Memorial Trust, Prime Minister Drought Relief Fund, Rajiv Gandhi Foundation, donation to any government or approved local authority for charitable purposes, donation to any temple, church, mosque, gurdwara or other place of worship of historical interest. Now, we are considering deduction available under Section 80GG in respect of payment of rent. This is available to an assessee who or his spouse or minor child should not hold any residential house property in India or in abroad. These two conditions are satisfied, only then deduction under Section 80GG can be claimed. First condition, the person or the taxpayer paying rent is a self-employed person or a salaried employee who does not receive any house rent allowance from his employer during the relevant previous year, and who or his spouse or minor child does not hold any residential house property in India and abroad. Then Section 80GG deduction can be availed subject to the list of the following: rupees 2,000 per month, 25% of total income other than long term or short term capital gains and after amount deductible under Section 80CC to 80U, and the excess of actual rent paid over 10% of total income other than long-term and short-term capital gains. Then deduction under section 80 GGA for donation made for scientific research or rural development. That is, this is also very much important towards economic development. Scientific research is for economic development and rural development is also for socio-economic development. So, any donation made for scientific research purposes or rural development purposes qualifying under section 80 GG is allowed as deduction, subject to satisfying certain conditions. The first condition that the deduction under this section is available to an assessee whose income includes income chargeable under the head profits and gains business or profession. Deduction is made or for payment or donation in research association, university, college, other institution carrying on scientific research which has been approved by the prescribed authority, or to a university or research association having the objective to carry on research in social science or statistical research duly approved by the prescribed authority, or to an approved association or institution which has as its object the undertaking of any program of rural development, or to a public sector company, local authority or approved institution for carrying out any eligible project or scheme on rural development duly approved in this respect. Then deduction 80 JJA. Section 80 JJA has been instituted by the Income Tax Act, where if the gross total income of an assessee includes any profits and gains derived from business of collecting, processing and treating of biodegradable waste for generating power or producing biofertilizer, biopesticides or other biological agents, or for producing biogas, or for making pellets and briquettes for fuel, or for organic manure. If the activities of these are taken by an assessee, then section 80 JJA is available, and such activity of collecting and processing biodegradable waste should be part of the business of the taxpayer. The amount of deduction available under section 80 JJA is 100% of the profit derived from such activities. Then section 80 JJAA, section 80 JJA deduction from gross total income for employment of new workmen or additional workmen is available only to Indian companies. Income of the taxpayers include any profits and gains derived from any industrial undertaking engaged in the manufacture or production of particular thing. The industrial undertaking is not formed by splitting or reconstructing of an existing undertaking or amalgamation with another industrial undertaking. The taxpayer company must submit along with the return of income the audit report in the prescribed format containing such particulars as may be prescribed in this respect. The deduction for this purpose under section 80 JJAA is available only if it is claimed in the return of income. The amount of deduction available under section 80 JJA is limited to 30% of the additional wages paid to the new regular workmen employed by the assessee in the previous year. This deduction is available for 3 assessment years, including the assessment year relevant to the previous year in which such employment is provided. That is, once the new workmen are employed, then in the relevant assessment year and thereafter 2 assessment years, this deduction can be claimed up to 30% of additional wages paid to new regular workmen under section 80 JJAA. Obviously, the taxpayer must be an Indian company. Then deduction in respect of intercorporate dividend under section 80M from gross total income, where the gross total income of a domestic company in any previous year includes any income by way of dividends from another domestic company, then in computing the total income of such domestic company, a deduction of an amount equal to the amount of dividend received from another company subject to the amount of dividend distributed by the first mentioned domestic company on or before due date of filing of return. Under section 80M of the Income Tax Act, the domestic companies that receive dividend from other domestic companies and declare dividend out of that dividend received is available. This section allows these companies to claim deduction for the dividend received, provided they redistribute the dividends received within 1 month before the date of filing the return, due date of filing the tax return. The rule applies to dividend distributed on or after 1st April 2020, that is assessment year 21-22 onwards. Domestic companies are eligible for deduction under section 80M as follows: amount of dividend received from a domestic company or corporation, or the amount of dividend distributed 1 month prior to the due date of filing of income tax return, whichever is less. This section 80M has been reintroduced with the objective to avoid double taxation. Then section 80QQB, this is deduction available under section 80QQB in respect of royalty income of authors, where taxpayers is an individual resident in India, whether Indian citizen or foreign citizen, or resident and ordinary resident, or resident but not ordinary resident in India, but not being a non-resident in India. This is available. He is author or joint author of any work of literary, artistic and scientific nature, but not including any brochure or commentaries, diaries, guides, journals, magazine, newspaper, pamphlets, textbooks or full tracts or other publications of similar nature, whatever name called. The gross total income of the individual includes any income derived from him, derived by him in the exercise of his profession on account of any lump sum consideration or payment received in respect of copyright of the book or royalty or copyright fees. The amount of maximum deduction available under section 80QQB is rupees 3 lakh, or the gross total income from royalty, whichever is less, that is actual royalty income, or rupees 3 lakh, whichever is lower, is allowable as deduction under section 80QQB. Then another similar deduction available under section 80RRB, that is deduction in respect of royalty payments. This is applicable subject to satisfying the following condition: the taxpayer is an individual, Indian citizen or foreign citizen, and resident in India, ordinary resident or not ordinary resident but not non-resident in India. The individual taxpayer is a patentee or co-owner of patent. Here patentee means the person being the true and first inventor of the invention and whose name is entered on the patent registered as a patentee in accordance with the Patent Act 1970. The individual taxpayer is in the receipt of income by way of royalty in respect of patent, which is registered under the Patent Act after March 31st, 2003. It includes any royalty income from working of or use of patent, including lump sum consideration for the transfer of all or any right in a patent. Deduction under 80TTA and 80TTB. Deduction under section 80TTA is available only in respect of individual who are not senior citizen, that is below the age of 60 years, and section 80TTB is applicable to taxpayers who are senior citizen or super senior citizen. Now deduction under section 80TTA, it is provided that deduction of rupees 10,000 in aggregate is available to an assessee, individual or in the ordinary family, in respect of any income earned by way of interest on deposit, not being time deposit or fixed deposit in any bank under the savings bank account scheme. The deduction is limited to 10,000 per assessment year. Then deduction under section 80TTB, this is applicable only to resident individual being senior citizen above 60 years of age, and interest income includes deposits on savings bank account or fixed deposit with any bank account, cooperative bank, post office, etc., and the amount of deduction maximum available is rupees 50,000 in a previous year. Now deduction in respect of person with disability under section 80U. This deduction is available under section 80U to provide benefit to the taxpayer for treatment of his disability. Deduction under section 80U is available to disabled or differently abled individual resident assessee for medical treatment of his disability due to some specified diseases like blindness, leprosy cured, mental retardation, locomotor disability. Here the term locomotor disability means disability to move from one place to another. That is it relates to problems in limbs of the assessee and other problems like problems in bones, joints, muscles, etc. Rupees 75,000 is the amount of deduction available to an assessee where the disability is 40% or more of the taxpayer. But if the disability of the taxpayer is 80% or more, then the deduction will be 1,25,000 irrespective of actual expenditure incurred by the assessee in this aspect. Thus, deduction under section 80U is available irrespective of actual expenditure incurred by assessee, that is straight deduction of 75,000 for disability up to 40% or more, and 1,25,000 straight deduction for disability for 80% or more. While filing the income tax return, the taxpayer must submit the appropriate medical authority certificate to defend his claim. Otherwise, it will not be allowed as deduction under section 80U. Thank you all.